Good afternoon. Thank you so much for joining us. What do these images have to do with helping your client make money? Now, the answer is that these are only three, Marriott, McDonald's, and FedEx, of what are only over 900,000 corporate clients that use Cintas for their uniform needs. Now, Cintas is a publicly traded American company, founded in 1929 as a rag salvage business, and by 1955 had only 15 employees. But by 2015, it has exploded to over 30,000 employee partners. It's divided into three main operating segments. The first is rental, uniforms, and ancillary products, and this makes up approximately 71% of total revenue. Uniform direct sales, and this represents approximately 10% of total revenues. And first aid, safety, and fire protection services, representing about 11%. Now, the remaining 8% was made up of document retention or document management services, but in 2014, they sold that division to Shred-it International, and they retain about a 42% interest in that resulting partnership. So Cintas, as you can see, has consistently outperformed the Standard & Poor since 2011 in terms of total growth. See a little better there. It has also performed very, very well and very consistently since 2010, roundabout, in terms of earnings per share and dividend growth. Now, it's currently priced at $81.65, but we estimate that that price will actually increase to $87.60, representing a 7.29% upside. Therefore, we enthusiastically issue a buy recommendation for the following three reasons.
Thanks, Liz. So I'll walk through the following next three reasons why we feel that this is a good buy, starting with their robust business model. Cintas has over 900,000 customers, of which none make up more than 1% of their total revenue. They also have very high retention of about 95% among their customers, so this provides very strong downside protection in terms of their revenues and makes them extremely stable. But the exciting part is the fact that as they create new innovative products and solutions and services for their customers, they can continue to sell within this existing group of businesses. So, in fact, if they just sold $10 more per week for each customer, it would result in an additional $450 million in annual revenue. They also have this extremely established infrastructure that would be very, very difficult to replicate or for someone else to come into the market and be able to do this. As you can see, they're heavily concentrated throughout the U.S. And as you can see, this is, somebody might be able to try and compete on a small local level or within a city, but nationally, it's very difficult for anybody to be able to replicate this. They also have a very sophisticated competitive intelligence network where they really listen to their employees and they ask their people on the front lines every day, what do you need in order to be able to increase your revenues? What products and services do you think would be helpful to help provide those to your customers? So they have a way of bringing that up to C-level executives who can quickly bring those new products and services to market. And these are just a few examples of what they've been able to come up with excuse me, in the last 5 years. They also have high growth potential, and specifically what we mean here is that, as you can see, this is a breakdown of where the demand comes for the difference from the different industries. Manufacturing within the U.S. we're very bullish on as companies are starting to reshore a little bit, and that's being revived within the U.S. But specifically, we're very excited about healthcare and accommodation. Healthcare, which is constantly evolving, but with Obamacare, there's going to be a lot of new people on the system now, and we see very good growth potential there. And accommodation, especially as businesses are now picking up, traveling. The hotel industry is doing very well, and they make up a large demand for their services. Next, just talking about the end market being the unserved customer, there's still a large group of people that don't buy these services. So, when you look at who's going to penetrate this market, we really feel like Cintas is the best one because every metric we look at, Cintas has the best employees, the best company culture, and we just decided to highlight here. You can see that the net income per employee really represents how they're the most efficient employees, and we think they do an outstanding job. And then finally, Cintas does 97% of their business within the U.S., so they have very little international exposure. If they want to strategically try and move into that international market, they certainly have room to do so. Now, I'll pass it off to Juan.
Okay, next I'll talk about the strong financials of Cintas and competitors. The Cintas are expected to be 18% in 2015, and the Cintas has consistently beat across the last 3 years its peers in terms of ROE. The profitability is expected to grow with EPS growth of about $3.50 per share in 2015 to about $5.50 a share in 2020. The major share of the growth will come from the rental uniforms and the first aid and fire protection services. The Cintas profit margins are expected to be stable, and they are expected to beat the Bloomberg estimates of its competitors for 2015. The Cintas is expected to improve the liquidity with its strong cash generation and its high cash ratio of about 1 in 2015. So the cash flow from operations are expected to grow. And here I would like to make one point that the Cintas is more than enough cash to finance its operations, and I feel this cash could be helpful like in financing its various projects like dividend growth, share buyback, acquisitions and expansions. And also, furthermore, the decreasing debt to equity ratio and increasing coverage ratio leaves the headroom for the Cintas to increase its debt at the lower cost of capital to pursue its projects.
So we valued Cintas primarily using a discounted cash flow model. These are our inputs here with the WACC and terminal growth, and our output was $87.60 as a target price. Our terminal growth rate was based on historical growth of Cintas over the past 5 to 20 years, and you can see that our figure of 3% seems reasonable, although it is conservative, and the sensitivity analysis here shows that if you were to increase it by 0.5%, the stock price would rise to nearly $100 per share. And then there were 6 key drivers that we used in our model. Some of them were already touched upon earlier, so we've discussed GDP, unemployment, and the share buyback programs. So nearly every company is already directly affected by GDP, but Cintas is more so than others, and this is based on our regression analyses running quarterly revenues against GDP for the past 10 years, and those analyses showed a high correlation between the two. And then there's an even stronger relationship between unemployment rates and Cintas' revenues, although it is an inverse relationship. And this makes sense because as more companies begin to expand and grow, there's more demand for Cintas' products and services. And we forecasted healthy rates for both unemployment and GDP, which allowed us to forecast anywhere between 5 to 7% in annual revenue growth over the next 5 years. And then there's also the share buyback program that creates value for Cintas' investors. Since July of 2013, they've purchased over 4.3 million shares at an average price of $60.87, and you can see the positive impact it's had on their share price. And then earlier this year in January, they announced another $500 million share buyback program that is not reflected in our target price, but we believe that if it is fully and effectively implemented, it could have an impact of 20 to 25 cents on earnings per share, and then ultimately a $4 to $5 increase from our target price. And finally, we did a peer analysis to kind of stress test our VCF valuation. We didn't directly factor it into our target price because we didn't feel that there were truly enough comparable companies that were truly comparable to Cintas. But from the selected peers that we've chosen, you can see that Cintas trades relatively in line with most ratios, and because of this, we believe that our target price is fair.
So let's have a look at the investment risks. We evaluate the Cintas risk based on the likelihood and potential impact that they might have on Cintas revenue. We would like to focus more on the 3 main risks, which are economic conditions, industry competition, environmental laws, and regulations. Based on our model, we perform a sensitivity analysis to come up with the share price in the upside case and the downside case of GDP growth and unemployment rate. If we expect no growth in GDP, the price would drop to 67 and 82. In favorable condition, we expect the price would be 105. The same for unemployment rate, the range of the price would be from 70 to 99. As we can see in here, the industry line and supply is very fragmented. 43% of the market share is made up by the small players in the industry. which indicated that in the local level, the industry is very competitive. However, on the regional level,
Time. So yeah, let's move on to the Q&A. Thank you.
Question, you mentioned international expansion opportunities. Didn't they just exit a couple international markets in the last couple of years? I think in Puerto Rico and maybe Canada. And can you kind of, what are you thinking, or what might they be thinking on international expansion if they just kind of put their tail between the legs?
Yeah, I mean, we didn't factor that into our model because internationally it has been challenging in the past. I believe they still have a presence in Canada. I'm not really sure about Puerto Rico, but certainly in different countries, people still need to wear uniforms. We know that there's still a need for the business services they provide. It might come in the form of a partnership, or it could come in various different forms. It might not necessarily mean that they're going to launch an aggressive campaign in a certain country, but we feel that since they are just so heavily concentrated in the U.S., that we do think that they could make it work, but I think they know that their core is here in the U.S., so they'll probably, if they did do it, it would just be a small upside potential with the stock.
Question for you on your initial discussion was on the dividend growth. Historical values, they've obviously grown their dividend quite strongly over the last several years. What do you, I don't know if you thought about what kind of sustainable growth rate for the dividend going forward? And then that's the first question. And secondly, you have a buy. As a team, do you think that just looking at that, $81 to $87 is enough to interest a portfolio in a name like that? Or are you kind of forced into that selection?
Well, maybe I'll take the second one. Do you want to take that?
Yeah, the dividend growth it's been high, relatively high, because of the dividend's only been 85 cents per share. Well, it is now. So I guess a 10% growth back when it was about 45 cents or so wasn't, a substantial increase. But it's not necessarily sustainable to stay at the 10 to 15% growth, I guess, every year. So I guess that's kind of our long-term view of that.
So yeah, I think to answer your second question, I mean, the first thing I would point out is that when we finished our report, it was at $78 a share. So when we finished the report, it was $11. Or, I'm sorry, 11% upside. But I think when Tony was talking about his valuation, we felt we were really pretty conservative with a lot of the numbers we used. The 3% terminal rate, I know it's kind of an industry standard, but when you look at what they've been able to do, even going back 20 years, I feel like you could probably make an argument for 3.5%. And then when Quang was talking about the different, the sensitivity analysis we did, it shows that there's really not, even if the economy goes into another recession, unemployment skyrockets, there's really pretty limited downside potential. So I think as it would fit into your portfolio, it would be something that is going to be that stable stock that, I mean, we're very bullish on the stock for sure, but, we think reasonably with, a lot of the uncertainty, we use a lot of conservative numbers, so that's what we arrived at.
So in your modeling process, how did you come up with some of the expense metrics? How did you think about expenses?
We looked at expenses as a historical percentage of growth or of revenues, and also we looked at it from a margin standpoint as well. So
you just kind of got margins stable?
Yes. Some of the segments actually they did decreases, like the uniform direct sales was decreasing, but that's mostly because the uniform direct sales segment is kind of being taken away by companies that are switching to rentals. So those two segments, they kind of one tightened, the other one widened a little bit, but for the most part, the other two were staying pretty stable.
I if I could add one thing, I think when you talk about expenses, people have oil on their mind a lot too, with the low oil prices right now. And I think since we did basically factor in more historical average oil prices, I mean, we don't necessarily think it's always going to be this low. So I think on the expense side, there is still more improvement possible in their margins if oil did continue to stay low. A lot of their fleet runs on diesel, and they use a lot of natural gas. It's kind of very. I don't know if we need to. I don't know if you had that in mind or not. We did a little bit of an analysis about that because we wanted to get a feel for their expenses. Oh.
So this is what we project the impact of the falling oil prices is going to be on the Cintas for the last 5 years of projected based on the historical data that we found.
Do you consider this a scalable business model? And can you point to anything that would give you confidence, yay or nay, if it's a scalable model?
When you say scalable, are you saying to be able to expand?
Incremental profitability greater than the current average?
I think so because, what I would go back to, their business model, it isn't just the uniform rentals. So I think if that was all they did, I'd probably say no. But the fact that we didn't have a lot of time to talk about all their new products and services that they provide. So they can do things now like give compliance training, CPR training. They even clean restrooms. They do things, all sorts of different business services that fire and safety protection is huge right now. That's been growing at double-digit growth for the past few years. So I think we certainly would say it is.
Did you put any analysis into the management of the company or?
We did, and it is a relatively young management. So we think that's another bullish factor. The fact that a lot of, I think it's relatively, they're younger, but it kind of shows that we feel like they'll be around for a while. We know that they have a stake in the company, and so they're probably a little bit more willing to take some risks. Scott Farmer, I think, is 47.
He's 40.
49. So I mean, relatively young. Mike Hansen, who we spoke with or who presented, is like 50. So it's really relatively young. So it's not just a management group that's kind of wanting to be real conservative, and I think they're willing to take risks.
And it's also the fact that it's a family-owned company. That seems to us, it seems like it's a company that's going to look more for the long-term growth of the company as opposed to short-term profits. So I guess from that standpoint, the family values are also a factor in that long-term.
So in terms of having or having a younger management team, how much impact do you think they've had on the historical results of the company?
I mean, I think some of the risks they've taken with their new innovative products and services. I think the competitive intelligence network, I mean, it shows that they're willing to, they're really in tune with their employees. I mean, I think that's what's cool about Cintas is that they, it's not just management that thinks that they know what's best and they make all the decisions. They ask their employees, what, let's use the knowledge of everybody that's on the front lines and knows what people need, and so they can quickly provide those. So I would think a younger management team, there's no way to know going back how it would have looked differently necessarily, but I think that's an example of how they are using technology, and they're aggressively trying to grow a business. Sure.
So looking at their operating efficiency, and I think it showed that they earn a higher return on equity than some of their competitors. I mean, do you think there is an opportunity for them to buy any of their competitors and implement their business model and add value that way?
Okay, so I'll answer that question. I really think they have more than enough cash, as I said. At Cintas, there is an opportunity, but it's really hard for us to make a comment about a specific company, like they feel like this is a specific company they are looking to acquire. But there is definitely an opportunity, and we believe like that could be the potential upside that we haven't factored in our models. So should there be any news to come in the market, that should significantly push up the prices if that is factored into our model.
I would like to add one point. Cintas has a fair amount of cash ready in their reserve, and they have good credit credibility. So in case if a potential acquisition show up, they can use their cash reserve, or they can use a leverage. Thanks to the fact that they have a high credibility, they can borrow credit with the interest rate. So we cannot say what specific tactic is, but we can say that Cintas is always ready when the tactic is shown.
I think the last time that there was discussion about potentially acquiring or merging with one of their bigger competitors might have been G&K. I'm sorry, it might have been Aramark, because their uniform rental business is only 25% of their overall revenue. So they've definitely explored some of those bigger acquisitions, but mostly it's been some of the smaller players. So we think that will continue to be a part of their business model, but management has said the valuations are very high right now, that it's a little harder to find good deals right now. So it's been slow, so they've been growing organically, and they obviously have been buying back shares, so using the cash that way.
That's the time we have. Thank you so much, UC.
Thank you.